Hello learners, today we want to learn about stock valuation. Today we want to learn about stock valuation. Stock valuation. So, what is stock valuation? This is a topic that we look into how we come up with our end stock value. What at the end of our financial month, year, or financial period, what do we come up with as our stock value, or as the value of our stocks? It looks more of the movement of our stocks in the stores, in our various stores, when the stocks come in and when the stocks goes out, how we keep track of our stocks. So we are going to look at various methods of stock valuation. And before that, we look at what is stock valuation. Therefore, in a period, stocks are normally purchased at different price and for a product costing purpose and profit determination. Stock have to be appropriately valued. This is because when stocks are transferred to the stores, they lose their identity and the issue price may not be accurately determined. This means, for example, on 1st May, you bought a stock worth 50,000 shillings. But you realize that the following, because of you keep on moving the stocks, later on 5th, you bought again 5th May, you bought a stock. This was like, for example, 10 items. Then you later on bought another stock on May 5th that was 55,000. And this was, let's say, 15 items. If you look at these two stocks, they are of the same item. For example, let's say this is oil, cooking oil. You realize that the stock you bought are probably different in quantity and price. But what are we really looking at? What about their cost per unit? What about their cost per unit? You find that this one would be 50,000. You divide it by 10. This gives you 5,000 each. 5,000 each shillings. But this, if you divide 15, if you divide the two, this is 55,000 divided by 50 units. This comes to 3,667 shillings per unit. You realize that these are different prices, different price tag per unit. And when you are issuing, when when you are issuing, because you are buying to sell, issuing, when you are issuing, probably on 7 May, you randomly picked one of them. You are randomly picked one of them. Now the confusion comes when you pick, for example, you sold this 15, 10, that is 25 units you have in your stores, but you end up selling 17. If you check, you notice you have sold some from here and some also from here. Different prices, but the same quality or the same item, it is oil, same item oil. But what the price at which you bought them differs. So you want to find out at what price or at what is the cost of these items that you issued out or you sold. That's what we now want to find out under this topic, stock valuation. This to exactly find out what we sold or what we have issued. That's the problem we want to solve today. That is the problem we want to solve today. That is the problem we want to solve today. Now, let us do away this. That is the problem. Now, we have two systems that we use in stock valuation. So let us do this. So we have stock valuation systems. Number one, we have periodic stock take system. Periodic stock take system. Periodic stock take system. Or it is also called physical stock takes. Physical stock take. Stock take. Now, what is this system? This is a system whereby you have stores. Probably you have a store, and you go to your store and start counting. Physically, you count 1, 2, 3. These are the things I have in my stores. It is where you count your stocks physically. You count your stock physically at a given period. Let's say you have decided that you are going to count your stocks at every month, at the end of every month. So at the end of every month, you go with your team to the store and count your stocks physically. That's what we call periodic stock take system. Periodic stock take system. Then there is number two. Number two, we have perpetual. We have perpetual stock continuous system. In a continuous system, it is always computer-based. This is a system which is always computer-based. So what you do, you have a computer system, of which you record your stocks as they come in and as they go out in every single transaction. In every single transaction. The moment you purchase stock, you record. When you issue it, you record. So this is something that you, at a given time, even at any point of time, you will just go and notice that these are the number of stocks that I have in my stores. And these are their prices, or these are their value. These are their value. These are their value. Now, today we want to specifically look at this system, the perpetual continuous system. The perpetual continuous system. This is what we want to look at in details. Let's see, a transfer system where stock records are maintained as per transaction. Each receipt or issue of stock is recorded and stock records. Therefore, readily available, and this help address the problem of overstocking and understocking. This system will actually help a lot. You will know at what point you have what and what time you want to issue. You know very well what you have in your store. So you will not be in a panic when there is an order to release the stock, because you know at a given point, at a click of a button using in your computer, that this is what I have in my stores. This is what I have in my stores. Okay. Under this system today, we want to look at what we call first in, first out. First out. We want to look at what we call first in, first out, or FIFO. What is FIFO? This is accounting method of inventory valuation based on the assumption that goods are sold or used in the same chronological order in which they are bought. They are used in a chronological order of which they are bought. For example, we had bought oil. Okay? We had bought oil on the first May. First May. Do it properly. For example, first May, you bought 1 liter oil, 1 liter can oil, 1 liter jerry can of oil, and this you bought at 300 each. Shillings 300. That's 1 liter made. And probably you bought 20 of them. 20 pieces. Then you went ahead and bought another on May 2nd. You bought another 1 liter jerry cans at a price of 250. And this time round you bought 15 pieces. When you get to 3rd May, when comes 3rd May, you got an order from your customer. And your customer told you your customer told you that he want 25 pieces. 25 pieces. 25 pieces. For you to get the value of these 25 pieces you have used, you use the FIFO, meaning first in, first out. So probably at this point in time, you will notice that you will start with this. This one's the one came in first. Okay? This batch came in first. This batch came in first. So you will give him 20 from this batch. Give him 20 from this batch. Okay? 20 pieces. These 20 pieces, you bought them at 300 each. 300 each. Okay? That is the price you bought them. Okay? So at this point, the value here is what? 6,000 shillings. Okay? Okay? 6,000 shillings. It is 20 pieces and 300 per piece gives us 6,000. But the order was 25 pieces, which means you have not given out the net around 5 pieces. You go to the next order, the next order that they gave. So you go to this one. Okay? Second. Okay? So here, under this, you take 5. Under this, you take 5 pieces. At a price of 250 each. 250 each. And 250 each times 5 times 5 times 5, that is 1,250. I guess I'm right. I believe I'm right. 2,050 times 5, 1,250. Now, what is the value of the product or the stock you have issued? What is the value of the stock you have issued? It is the additional, the sum of these two. The sum of these two. So that one will be 7,250 shillings. You see, this is what we call FIFO. The first one that came in goes out first, followed by that chronological pathway. Okay? The first comes, second comes, third, and so on and so forth. So this is what the FIFO system look like. Remember, this is a controlled system in your computers, so you just do the records. You just do the records and everything is available for any user. Now, let us look at advantage of this. Advantages of FIFO. Advantages of FIFO. Number one. FIFO method yields higher value of the ending inventory and lower cost of goods sold. So this is lower cost of goods sold, especially during inflation. For example, if the opposite was For example, if this one there was an inflation, so at this point you bought them at 300, and the following day you notice that the price has increased, and therefore the price goes up to 400. You'll notice that the first items that you will sell are from this point, and from the first in, first out. So from the first items bought. So therefore, at this point, this value will remain the same. It will be more. It will be cheaper than this one, which will return to be 400. Okay, so when the values, when there is inflation, you find that FIFO give you a leeway that when you sell your goods at the end of the day, it will now change to be the cost of goods becomes lower. So this becomes 400 times 5. That's 4 times 5, that is 2,000. So this becomes 8,000. What about the person using LIFO? There is also another one which is called LIFO. This is last in, first out, which means this one is supposed to be sold first. If that was the case, then at this point you notice that this person would have sold 15. At a price of 400 and 5, only 5 at a price of 300. Okay? If you do your calculation, you will find out that this becomes much more cheaper. So that is 15, much higher. Okay? 15 times 400, that will give you 600. Then 5 times 300. This gives you 15. Now look, it seems to be, now this one will be not this one will not be 5. This one will be 300. But the guy wanted 5, so this will be 10. 10 remain, so this one will be 10, not 5, 10. So therefore, if that is 10, then therefore this one becomes 3,000. Total becomes 9,000. As you can see, it is cheaper. It is much higher than the price when we use FIFO. So during inflation, then it is for you to get a better result in terms of cost of goods sold, you better use FIFO, not LIFO. Then advantage number two, it results to higher profit. If you have a lower cost of goods sold, then it is very probable that you are going to get higher profit out of your business. Then it also leads to, this is just an advantage in the side of government. there will be higher taxable income. There will be higher taxable income resulting from this high profit. Resulting from this high profit. Resulting from that high profit. Now, having done all that, and now you understand this first in, first out to a given level. Now I want us to do a question. Look at a question. Let us try a question to help us understand this concept better. Let's try a question. Let us try a question. Let's try a question to understand this concept better. So it is FIFO. So we are dealing with FIFO. Let us have everything. We are dealing with FIFO. We are dealing with FIFO. First thing, FIFO. That's what we are working on. Now look at an example. Let us look at an example. Let us look at an example. An example. Now, example. We have a question here. Nyali Valley Limited are retailers who sell ceramic tiles. During the month of July to September 2000, there were price fluctuations. Due to the above problem, the company had to adjust its selling price. The following transaction took place during the period. First transaction took place on 3rd July. Opening stock was 500 tiles valued at 825 shillings. Orders, 10th July, orders placed with the company increased, so extra tiles had to be obtained from Mombasa. Therefore, 22,000 tiles were purchased at a cost of shillings 140 each. But in addition, there was a freight and insurance cost or charges of shillings 5 per tile. Okay? 31st July, during the month, 20,000 tiles were sold at a price of 220 each. 4th August, a new batch of 14,000 tiles were purchased at a cost of shillings 175 per tile. On 30th August, the sales of the month of August were 14,000 tiles at a selling price of shillings 230 each. September 1st, a further 24,000 tiles were purchased at a cost of 195 each. 30th September, 27,000 tiles were sold during September at a price of 240 each. The cost accountant of Nyali Bali Limited decided he would apply first in, first out basis required. Stores ledger account using first in, first out method and showing stock values at 30th December 2000. Now, first thing first, what we are going to be doing is a ledger for the store. It is a store ledger. So whenever you notice that you are working with the store ledger, we are not being asked about the profit and loss account. So everything here now we deal with the cost, not the price at which the item was issued. So don't just forget about the price at which an item was issued. For example, where you are being told here that during the month 20,000 tiles were sold at a price of 220 each. That price of 220 is not applied in ledger, in this store ledger. It is not applicable in this store ledger. And we are going to look at it, and I'm going to show you why I'm saying so. Because in store ledger, we are not looking at profit or loss. We are looking at the value of the stocks that we have issued. Therefore, we are going to do that ledger. Let us do it here. Okay. So we have Nyali Bali Limited. Okay. Stores ledger. For July to September 2000 using FIFO. Okay? Using FIFO. Now, these are what you must know about a store ledger. A store ledger has a date. A store ledger must have a date. Okay? A store ledger must have a receipt. Daily receipt. This is what is coming in. Then it must have what is going out, that is issues. What you give to the customer. The product comes in, you record the date, it comes in, then there is a time it is being given, you sell it to your customers, that is the issue, it goes out. Then when it goes out, it creates what we call a balance. We will have a balance. What is remaining in our stores? What is remaining in our stores? So that's how this ledger looks like. That's how the store ledger looks like. Okay, that's the ruling. The store ledger. Okay. Was store ledger. All right. Our store ledger. Then, in this, you notice that you will be having units, the units you have issued, cost per unit, cost per unit you have issued, cost per unit you have issued, cost per unit, And then you are going to have the value or amount. Values to amount. Okay? Same here. You have the units. We have the cost per unit. Then you have the value, amount. Same here. You have units. You have cost per unit. Then we have amount, value. So that's what we have. You rule your work very well. Okay. Now, after that, you start answering your questions. After doing all that, you start answering your question. Now, July, the 3rd July, opening stock was 5,000 tires, valued at 825,000. Value at 825,000 shillings. That is the opening stock, which means at the beginning of this day you had a balance. So a balance of 5,000 units. 5,000 units. Cost per unit. We are going to find out, but the value is to 805,000. So value per unit will be simply 825,000 divided by 5,000. What do you get? 825,000 divided by 5,000. So each tile was 165. That's the price of each tile. Now, on 10th July, what happened? Orders placed with the company increased, so extra tiles had to be obtained from Mombasa. Therefore, 22,000 tiles were purchased at a cost of 140 each. But in addition, there was a freight and insurance charge of 5 shillings per tile. There was a insurance charge. So each tile, the purchase price was 140. But what is the value of these tiles? What is the value of one tile plus the freight and insurance? So it means when it hit your store, the price now includes everything that you have spent for the stock or for the item to move from the manufacturer or from where you bought it to your store. Every single coin you have spent, all the way from where you purchased it, all the way from the supplier to your store. That is what calculates to be the value of your stock in your store. So plus 5. So it 145. 145. So there was a purchase. There was a purchase of 22,000 tiles. 22,000 tiles. 22,000 tiles. What was the cost per unit? 145 shillings. 145 shillings. 45 shillings. 145 shillings. So what is the total? What is the total? What is the total? What is the total? So it is 22,000. 22,000. That's 145. It becomes, it is 31,900. 39,390. 3,190,000. 3,190,000. 3,190,000. Okay? That is the price. That is the price. Now, what is your balance at this point? What will be your balance? Your balance here will be your balance here will be 22,000. 145. This is 3,190. That is your balance. That is your balance. Now we move on. We move on. 31st July. 31st July. July. 31st July. During the month, 20,000 tiles were sold at a price of 220 each. 220 each. 220 each. On this date, tiles were sold. So we go to issue. We go to issue. Our part of the ledger, issue. So what was issued? It was issued units 20,000. 20,000. No, don't rush. What was issued was 20,000. But what we have in the store, we have these items. This one and this one. Here, you will notice that we have a total of 27,000. Okay? 27,000. If you add, you get something. Okay? But only 20,000 was issued. In most of the time, if you want to be on the safe side, do your math and get what you have here. This is 27,000. Okay? That's what you have on the opening day of 31st July. Tiles. What is the price? The price will simply be the 2. Addition of the 2. Okay? So you add them. Plus 825,000. This is before you issue. Before you issue 41. Let me 40. 1,500. Before you issue anything on that day, you had that as your balance. You have that as your balance. But you have issued 20,000 on that day. So how are you going to be issuing them? How do you find the value here now? The value here will be the first thing, which is 5,000. So the first thing in your mind, you ensure that you write that 5,000. That is what you issued first. What was the price each per tile at that point? Is 1,165. So the tile you issued here is 825,000. Now, what is the tile remaining? You have to issue 20,000. You have to issue 20,000. Okay? You are to issue 20,000. You are to issue 20,000. Yeah. You are to issue 20,000. But now you have issued 5,000 from this first stock that you received from the previous month. Okay? So minus 5,000. What do we have remaining? What we have remaining is 15,000. Now you go and say you issue again, very moment, another 15,000. Another 15,000. But what is the price of a unit, or price of each item, or price per unit is that one? Okay? So here you have 145. 145. So the total cost, or the total value of what you have issued is 15,000. 15,000 times 145 is to 2175. 2,175,000. 2,175,000. So the total cost of what you have issued, or the value of what you have issued, you can easily find. You don't need to. You can easily find what the total cost of what you have issued. Here you have issued how many? Hapa ni 27? No. Yeah? No, 20. This is 20,000. Here it becomes plus 82.5. That's give you 3 million. So that's the value of what you have issued on that day. That is the value of the tiles you have issued on that day. What are you left with? What are you left with? What are you left with? You had 20,000. You had 27,000. You have issued 20. You remain here with 7,000. 7,000. What is the price? The price of each unit is 145. This one, this line. This is what remains. Now, what is the value of what remains? 7,000 times 145. 145. That's 1,500,000. 1,015,000. 1,015,000. 1,015,000. 1,015,000. Now you move to the next day. To the next day. 4th August. 4th August. 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 4th August. What happened on 4th August? A new batch of 14,000 tires was purchased at a cost of 175 per. Okay. So 14,000 tires were purchased. 14,000 tires were purchased. 14,000 tires were purchased. What is the purchase price of the cost? 175 each. 175 each. 175 each. 14,000 times 175. That is 2 million. 2 million. 2,450,000. 2,450,000. Let us continue. 2,450,000. Now, what is the balance? What is the balance? The balance here therefore be, you have 14,000 at 175 and at 2,045,000 and 2,450,000. That's what you have as a balance. That's what you have as a balance. Let's move to the next date. There is no issue on that date. Then on 30th August, the sales for the month of August were 14,000 tires at a selling price of 230. We remember we said we don't deal with selling price here. We are only looking at the cost. We are only trying to find the value of the stock we are issuing to the customers. The total value of what we are selling. The total cost of what we are selling, not the price at which we are selling or how much we are selling at that point. Not the revenue. We are not interested in the revenue. We are only looking at the cost. We are doing the costing of the stock. So on that 30th August, the sales for the month of August were 14,000. So in this month, we sold 14,000 tires. 14,000 tires. Okay? So that simply means we go back to our store and look at what we have. We go back to our store and look at what we have. First, we have 7,000 tires in our store. So that's what we are going to issue first. So at the issue, what we issue first is 7,000. 7,000 tires. 7,000 tires. At what price? At what cost? 145. At what cost? 145. That's the cost. What is the total? 1,015,000. 1,015,000. 1,015,000. Now, what is remaining? We have issued 7,000. We have issued 7,000. We are remaining with another 7,000. Okay? Another 7,000. We are remaining with another 7,000. Another 7,000. We issued it at 175. 175. So 175 times 7,000. 175 times 7,000. Times 7,000. You get 1 million. This become 1 million. 5. That's 1 million. That is 1 million. 225,000. 225,000. So the total of what we have issued is 14,000. 14,000. You cannot do the cost per unit because they were from different batch. So at what is the price here? It's the total cost, the total value on that date, the total value plus 1 million. This is 2 million. 240. So it is 2 million 240,000, 2,240,000, 2,240,000. Now, what is your balance? What is your balance? What is your balance? What is your balance? Your balance is 7,000. Remember, this one and part of this one was issued. At this point, in this batch, we only issued 7,000. So we are still remaining with 7,000 of that batch. 7,000. 7,000. The price remain, that amount, that's the cost. The cost remain. The cost remain. So this give you 2,000, 1,225,000, 2,225,000. 225,000. So that's what remains in your store. That's what remains in your store. That's what remains in your store. Now, another day, 1st September, 1st September. 1st September. What happened? After a further 24 tiles were purchased at a cost of shillings 175. A further 24,000 tiles were purchased. 24,000 tiles purchased. 24,000 tiles purchased at a cost of 195. That's the cost, 907. 195. So 24,000 times 195 times 195. What do we have? It is 400. Let us do it somewhere here. 468. No, 4,680,000. 4,680,000. 4,680,000. So what do we have in your balance? What do we have in your balance? We have 24,000 tiles. 24,000 tiles at 195. At 195. And a total of value of 4,680,000. 680,000. That's what we have. That is what we have. That is what we have. Now we continue. Let us do away with this point because you have what is there. You have done with this one. Let us create a space here. Create a space here. Just creating a small space here to finish. Creating a space here to finish. Creating a space here to finish. Creating a space here just to finish. Okay? Creating just a space here to finish. Now, on 30th September, 30th September, 30th September, 27 tiles were sold during September at a price of 240 each. There was an issue. And there were 27,000 tiles. They were issued. This is the 27,000 were issued. 27,000 were issued. 27,000 were issued. 27,000 were issued. Now, where did this 27,000 came from? First is this one. From there. 7,000. So what was issued first was 7,000. Okay? What was the price? What was the cost? The cost was 175. 175. Total into value into 1,225,000. 1,225,000. Then, when that happened, we removed the 7,000. So we remain with 20,000. That's what we remain with. On 20,000, we had this 24. So we had 24. We had 20 now. 20 out of those 24. At 195. 195. At 195. At 195. At 195. So 195. 195. 195 times 20,000. 39,000. 3,900,000. 3,900,000. Now, what are we remaining with? The balance. The balance, therefore, is 4,000. Remember, we again from this 20, we again remove from this 24. This 24, we issued 20,000. We issued 20,000. From that 24, we issued 20,000. So what we remain here with is 4,000. Is 4,000. At what price? 195. 195. So 4,000 times 195. That is 78. So 780,000. 780,000. 780,000. And therefore, we were asked as stores, this is the question we were required to solve. As stores ledger account using first in, first out. That's what we have done. Then, and showing stock values at 30th September. Stock values. This is the stock value at 30th September. That is the stock value at 30th September. Thank you for watching. Thank you for paying your attention. Welcome to our next class. That will be cost accounting. We will be doing LIFO. We will be doing LIFO next. LIFO is just the opposite of this. So what comes out is what came last. That's the way the name suggests. LIFO, last in, first out.